all, I would like to sincerely thank and welcome every one of you for coming to this IGE KITA forum. I'm Lee at KITA, and I'm here now on behalf of Dr. Il Sabong, who is the chairman of IGE, and he used to moderate this forum. But as you know, now he is serving for the Korean government as the chairman of the Presidential Commission on National Competitiveness, and also concurrently he's a special economic counselor to the President Lee Myung-bak. So because of the very heavy schedule, and as you know, President Lee Myung-bak is called the early bird. He calls meeting very early in the morning, so often. So I think Il Sabong is now in the meeting in the Blue House. And this morning, it is our great fortune to have a chance to listen to Dr. Dallara's presentation on what is going on in the global financial market and the global economy. Many of us here are, I think, economists by education. I'm also the economist. And then by education, we are inclined to believe that the workings of the invisible hand, although sometimes we do not have full confidence in workings of the invisible hand, but fundamentally we have some confidence in that. But regarding the timing of his visit to Korea and particularly to this forum, I really believe that invisible hand is working. The timing cannot be more appropriate. Just yesterday, we witnessed the financial meltdown, we can call it. The tailspin drop of the stock prices, or the fluctuations of the foreign exchange rate, like that. And now we are in the midst of the uncertainty. We don't know to what direction this current development will proceed. Then Dr. Dallara came to us to tell us and to help us understand better about current global economic situation. So it is our great fortune, really our great fortune. So you are really blessed in that regards. I congratulate for that. You have a very detailed the personal history of Dr. Dallara with you. As you know, he has a very long and rich working experiences in U.S. Treasury, in the IMF, and since 1993, he has been the chairman of the Institute of International Finance. So he is the most appropriate speaker on the hottest topic of the global financial economy today. So we are looking forward to listening to his presentation. Let's join me in welcoming him.
Thank you very much, Dr. Lee. It is, as always, a real pleasure to be back in Seoul and to be back into the Institute for Global Economics. Indeed, Dr. Il Sabong called me some months ago after he had accepted this important position for the new government of President Lee. And we talked a little bit about economic matters globally, economic issues here in Korea. And he said, I would really like you to know that we still in spite of my new responsibilities, we would still like you very much to come back to Seoul and speak to us once again about the global financial environment. The only special request I have, he said to me, is that I want you to promise you will come at an exciting time. So I have fulfilled my promise to him to come at an exciting time. And I completely understand that although he is not with us here this morning physically because of his obligations to the government, that he is always with anything interesting that happens in this wonderful institute, which in my view has done so much to stimulate thinking, to stimulate analysis, and to stimulate the globalization of the intellect of Korean economic and financial leaders. And I think that is so important as your economy globalizes, as your financial system globalizes, to also globalize the thinking and the direction of thinking of the leaders of this wonderful country. And I think that is what IGE has done so marvelously well. Before I dive into these very complex and somewhat painful topics, I have a question for you that relates to my last visit here, which was some 18 months ago. We have all just witnessed the remarkable hosting of the Olympics by our friends in your neighbor, China. But what do you think was the most impressive Olympic victory in that 3 weeks of competition? Of course, I am not the final judge, but for this morning I can express to you my opinion. What was the most impressive victory? Would anyone like to show your hands? Was it Michael Phelps? This gentleman has come quickly to the answer here, I'm afraid. Because even though I think we were all stunned by the remarkable performance of many of the athletes, including Michael Phelps, including the Jamaican sprinter Uwe Bolt, including the remarkable performance of the Chinese athletes themselves, who outperformed themselves during this remarkable 3-week period. To me, the biggest achievement was Korea winning the Olympic baseball gold medal. I have to congratulate you. You know, during my last visit, I had noticed outside my hotel the impressive fields that you have created, the baseball diamonds you have created, not just for your college players and for your professional players, but for your 7-year-olds, your 10-year-olds, your 12-year-olds. And so it did not surprise me at all to see that Korea won this remarkable competition. I think the U.S. came in third, which was not bad, all things considered. But now my only request is that you send some of the talent, not too much, just some of the talent to the New York Yankees, because we're in desperate trouble back in the U.S. right now, and we need some good Korean baseball talent. But no, to me, this in many ways symbolizes Korea's achievement, ability to focus on something important and to gradually build to world-class level. I think that's what you have done economically, it's what you have done financially, it's what you have done in so many areas of life in these last 5 decades. And I'll return to that at the end of my remarks this morning to talk about some of my current perceptions of the Korean economy and the outlook for the Korean economy in this remarkably volatile and uncertain time. But let's talk about the global financial crisis. That's what you came to hear me talk about today, and then I'm delighted to exchange views with you through a question and answer session. We are clearly in the midst of the most challenging, the most turbulent, the most difficult, and the most complex financial crisis the world has seen since the 1920s. I can imagine no period in my 33 years in global finance, and from my reading of modern financial history, no other period since the late 1920s when the world's financial system has been so destabilized by such a complex, elusive set of issues. Of course, many of us have lived through difficult financial periods. Here in Korea, you had this remarkably difficult financial turmoil 10 and 11 years ago, which many of you remember all too well, and which I remember as well. During the 1980s, many debtor countries, the so-called less developed countries of that period, went through a very stressful period from 1982 to 1989, which posed heavy burdens on the global banking community. Indeed, if you look back some 25, 26 years, you would see that many of the world's leading banking institutions were probably technically insolvent. Now, we should not take away from that reality any special comfort about today's situations, because the environment surrounding the Latin American debt crisis was a much more manageable environment. We, those of us involved in trying to frame solutions to this, understood the problem. It had much fewer layers than today's complex financial problems. And most importantly, the accounting and market environment at the time gave a window of adjustment and a period of some years for the banks to rebuild capital and to position themselves eventually for the losses which were required through the Brady deal for this problem to be put behind both those countries of Latin America and elsewhere, and to put behind the banking community. Today, we do not have the luxury of time. The markets are demanding performance every day, morning to night, 24/7 virtually. And this is putting enormous pressure on not only the system, but on individual decision makers. There are some aspects of this system which we need to probably rethink. But in my view, the problems we have today have three key sources for your reflection. First of all, and this is not unusual, we find that these problems arose after a period of strong global growth and high international liquidity in financial markets, where investors and lenders began increasingly to chase short-term yield and short-term performance and lost some of the discipline that is so essential in finance today along the way. The incentives for short-term performance, both the financial incentives individually for individual employees and the incentives for corporate short-term performance, had built to tremendous and unmanageable levels in the last few years. And so these incentives, in my view, contributed heavily to the generalized breakdown of discipline in risk management in the financial markets. It was not only an environment of liquidity and growth in chasing yield, but unfortunately the second source of the problems we face today has to be laid at the feet of the large global financial institutions who allowed their risk management systems to deteriorate to a point where they no longer fully understood or were fully capable of managing the risks involved. Now you might say to me, well, it's not possible for any one chief executive or any one firm to completely understand the risks involved. And it is difficult, but it is possible and it is absolutely essential. Some years ago, after I left the U.S. Treasury Department, I worked for a number of years with J.P. Morgan in New York, and I had the responsibility for Morgan's business relationships and business development in Central Europe and the Middle East, as well as India. And we had lots of clients in the Middle East who had lots of money. and they like to do very complex things with their money. And one day, one of my traders came to me with a proposal for a very large equity derivatives trade, which was very complex in its structure. And it was of such magnitude that it needed the approval of the chairman, who was also the chief executive, Dennis Weatherstone. Well, I spent 2 hours with my team trying to understand the trade. And finally, I thought I had a handle on it. And I took it personally up to his floor, one floor above me, and said, Mr. Weatherstone, I have to seek your approval for this very complex equity derivatives trade. So he said, okay, Charles, if you want to do this trade, explain it to me. Well, I got about 3 minutes into the explanation, and he just kept firing questions at me, and he kept asking questions. And at the 3-minute mark, it was pretty clear that I did not fully understand this. I had maybe 2/3 of the understanding that was needed. And so his advice to me, and I was quite rather embarrassed, he said, Charles, you know, come back and ask me again when you really understand this trade. So I went back and studied for another 24 hours, and the next evening I came back to his office and I answered every question, and I was able to get his approval for the trade. But it taught me a lesson. It taught me a lesson that there is no substitute for unbundling the risk involved in any financial transaction and trying to understand what the risk to your own institution may be. It is particularly difficult today, of course, because although a firm may understand the risks involved in that firm's on-balance sheet, the interconnectedness of financial institutions is such today that no one firm can fully understand the systemic risk which may be building around them. So you may feel that your ship of finance is quite strong, but if you are in an armada of ships, there is no way, and all of you are mutually interdependent upon one another as financial institutions are today. There is no way that you can be fully confident that you understand all of the risk surrounding you. Coming back to the seeds of this crisis that surrounds us today, there was this seed of global liquidity encouraging bad risk management. There was this seed of allowing the discipline of risk management to break down. And there was this seed of weak regulatory supervision and weak oversight arrangements over certain important parts of our global financial markets. This was particularly evident in the United States, where we allowed mortgage business to be done without adequate supervision or regulation. And frankly, some of it went to the point not only of irresponsibility, but to the arena of fraud. Unfortunately, American regulators stood back and allowed this to happen. And equally unfortunately, and this is where the risk management comes in again, the leading global financial firms, many of them, took these subprime mortgages, bundled them together with other financial products, and created complex instruments which were then packaged together and sold to investors around the world. Unfortunately, every participant in that financial food chain has to take some responsibility for the weaknesses that were revealed during that period of time. The original mortgage brokers who engaged in irresponsible, and in some cases I would say even unethical and illegal activity. The underwriting firms who took these products and distributed them to investors without fully understanding or gauging or advising their clients on the risk involved. The rating agencies who were caught up in this process and who unfortunately had conflicts of interest and who lost sight of how to fairly and transparently rate the quality of the complex products. And then the investors themselves, of course, who were happy to take on this paper, which gave them higher return. And these are professional investors, and they should have known that along with higher return comes higher risk. Now, over the last year, of course, we have seen the consequences of this series of shortcomings in the financial system. And we are all struggling mightily to overcome the weaknesses which have been so painfully revealed. Many steps have been taken by individual firms to strengthen their risk management, to raise capital, to improve their business models, and to reduce the leverage in their balance sheet. Many steps have been taken by regulators and by central banks, and even today, you see within the last 24 hours the continued efforts of the world's leading central banks to provide exceptional liquidity arrangements, to provide an underpinning of liquidity in global financial markets today. We at the Institute took it upon ourselves to look squarely at the weaknesses that I have been discussing and to speak frankly about the mistakes that have been made by the global banking community, but also we took it upon ourselves to identify the kind of practices by the industry which in the future should mitigate the potential, should reduce the potential for a repetition of this kind of financial crisis. Of course, you never know where the next storm will brew from. And if you're sitting in the Caribbean or sitting in parts of the Pacific, you never know where the next hurricane or the next typhoon will come from. But you do know how to prepare for it. And that is what we've been doing for the last year or so. We created a committee, and this was supported by the world's top bankers. Our board of directors includes the chairman or CEOs or senior executives of the world's leading financial institutions. We're privileged to have had on our board of directors the former chairman of Woori Financial Group, who is now in the Blue House helping run the Korean government. And we look forward in the not too distant future to having another distinguished leader from the Korean banking community on our board. Because we are a very global institution. We have almost 400 members now, I think some 396. And we're very proud that that membership includes not just the leading banks of Europe and the US, but it includes 10 banks or 10 financial institutions from Korea, 15 from China, over 60 from the Middle East, a dozen from Turkey. So our membership is very global now, and our response needs to be very global. And so we created a committee which worked day and night for 9 months to develop a set of best practice recommendations for the industry. We looked at what went wrong in risk management, what went wrong in transparency, what went wrong in the ratings process, what went wrong in accounting. And believe me, accounting has been an important source of the problems and the instability of the last year or so. We asked many of these questions of ourselves, and we came up with a set of principles and a set of best practice recommendations for our membership globally. This is not about self-regulation. It is about the banking industry acknowledging the severity of its own mistakes and making every effort to rebuild confidence from the ground up. We released this report 2 months ago, and I'm pleased to say that it has been very well received. In these last 2 months, we've had an opportunity to present the report to leading officials just in the last few days here in Korea, but earlier to Chairman Bernanke and all of the top officials in Washington and New York, to the top officials and regulators of Europe, of Japan, of Hong Kong. And we are in the process of sharing this report with all of our member banks and top regulators around the world, and they have very warmly endorsed and embraced this report. But confidence, once broken, is an exceptionally difficult thing to rebuild. Trust, once broken, is an exceptionally difficult thing to renew. If you think back to what we should have known already about the foundations of the free enterprise system, we in global finance should have realized two things that actually Adam Smith told us over 2 centuries ago. First of all, that the world is really not about finance. It is about, the world of global economics is about production. And I quote one excerpt from Adam Smith's Wealth of Nations. Money, therefore, the great wheel of circulation, the great instrument of commerce, like all other instruments of trade, though it makes a part and a very valuable part of the capital, makes no part of the revenue of any society. And though the metal pieces of which it is composed in the course of their circulation distribute to every man the revenue which properly belongs to him, they make themselves no part of that revenue. Indeed, I think those of us in global finance need to remind ourselves that we are the means of facilitating global commerce. We are not the center of global commerce. And I think this is part of the mistake that has been made, is for the global financial community to believe that it was the center of global commerce, not the facilitator of global commerce. And as I mentioned, each financial institution, individually and all of them collectively, will need to set about rebuilding trust and confidence. You know, in the early days of banking, before there were central banks issuing national currencies, and this is a fairly recent phenomena, you know, to have a national central bank issuing a national currency. Even in Adam Smith's time in Scotland, just over 2 centuries ago, individual banks could issue their own currency. But what was the basis of that? When the people of any particular country have such confidence in the fortune, the probity, the prudence of a particular banker, as to believe that he is always ready to pay upon demand such of his promissory notes as are likely to be at any time presented to him, those notes come to have the same currency as gold and silver, from the confidence that such money can at any time be had by them. Well, of course, we now see that the reverse is true. If a financial institution in today's highly interconnected world cannot sustain the confidence of its investors, of its lenders, then it is in deep trouble. This is what is happening today in New York and in other financial markets around the world. These financial institutions coming under pressure are not insolvent in the way we would typically think of them as being insolvent, but they have lost the confidence of their investors and creditors. It is that simple. And it is crucial that we all work together now to stabilize confidence in the financial system, because in my view, it will be very difficult to solve the immediate problems by fighting each fire on its own. And even though I have great respect for what the Federal Reserve and what the Treasury are trying to do today, and for what other central banks around the world are trying to do, and I'm sure your own authorities are cooperating in this global effort to stabilize markets, I believe that we will need to think about some of the lessons learned here and about other ways going forward to strengthen the stability of the financial system. One of the recommendations that our committee made is that we would form a new global market monitoring group, which would come together sometime in the next few months and would meet on a quarterly basis, bringing the best minds in private finance around the world together to try to detect at an earlier stage the bubbles that had been so costly this time, to try to detect where risk is being mispriced. Because we now know, and many of us knew for a number of years, that risk was being mispriced throughout the financial system. But if this new group called the Market Monitoring Group is to be effective, it will not only have to identify potential systemic weaknesses in global finance, but it will have to convey them to the market participants so they can act at an earlier stage. Let me say a few things about the outlook ahead, and then I would like to talk about the global economy. Because many of you have asked me, and I was in Japan just last week with a number of my colleagues. The head of our Asia Pacific department, Greg Fager, is with me here this morning. And Greg and I were in Tokyo, and Greg said to me last night, because we gave a speech there last Thursday morning, how dramatically the world has changed in those 6 days. Indeed, that speech is worthless today, and I'm afraid that the speech I give this morning may have to be entirely revived by the time I have to give a speech next Friday in Chicago at a conference there. The world is changing so rapidly before our very eyes. And I do think that we are unfortunately in for some continued period of instability and stress in global financial markets. Some have asked me here in Korea and have asked me in Japan and elsewhere, is Lehman Brothers the last firm, or is X firm the last firm? And I wish I could say with confidence that it was. But I think that we have some dynamics in the system now which have to work their way through. And I'm afraid that it will take some months. These dynamics revolve around two fundamental vulnerabilities in the system today. That is the difficulty of stabilizing the value of these complex structured products, these so-called CDOs, collateralized debt obligations, which have been the poison for so many balance sheets around the world in the last year, and the related difficulty which we are having in the United States in stabilizing the housing market. And until these two related markets are closer to a point of stability, I'm afraid that we will continue to have stress in global financial markets. That does not mean, however, that we are not making some progress. And in the midst of all of the volatility of the last few days and the remarkable events with Lehman filing for bankruptcy, with Merrill Lynch being sold to Bank of America, with the pressure that is now very apparent on other financial institutions. In the midst of all this, it is easy for us to lose sight of the fact that there are underlying improvements taking place. And in dealing with these financial problems, firms have already written off almost $750 billion in bad assets, and they have raised capital equal to almost $500 billion. Now, there is more capital to be raised. But for many of the world's global financial institutions, they will not have difficulty raising capital. This applies to many firms in Korea, in Japan, throughout Asia, but it also applies to a large number of firms in the United States, Europe, and Canada. Many of these firms have reduced their exposure to these toxic credit derivative obligations. And therefore, even though there will be more quarterly losses as the value of those instruments continues to decline in the marketplace, nevertheless, the magnitude of those losses will be reduced, and you will see more evidence that many of these large global financial institutions have continued strong earning streams from their commercial banking activities, from their corporate banking activities, indeed some of them still from their investment banking activities, from their trading activities. And many of them actually are taking shares, market shares, away from some of the smaller players in global finance. As we know, coming out of a crisis like this, there will inevitably be consolidation in the global financial community. There will be winners and there will be losers, and there should be. There will be firms swallowed up by other firms, and there should be. And I do believe when we get through this phase, whether it is 9 months from now or 12 months from now, and my guess is it's something in that time frame, that we will have a more resilient, a stronger global banking system in place. And if you look today at the number of firms which seem to be under pressure compared to 6 or 9 months ago, that number is dwindling. Now, I grant you that the instability surrounding a few firms has spread throughout global markets. But I think we should not allow ourselves to think that the entire financial system is collapsing around us, or that the global economy is collapsing around us. When we were preparing for this trip some weeks ago, Greg Fager and I and some of our other colleagues at the Institute looked at Korea, and we were a little puzzled because there seemed to be talk about a crisis in Korea. There seemed to be a lot of anxiety about Korea. And viewed from Washington, we didn't particularly see why this was the case. Now that we are here, we're even more puzzled by what seems to be an unnecessarily high degree of anxiety in Korea today. Surely there is reason to be concerned about the global economy and about its effects on Korea. Korea is now, today, much more than 20 years ago, and even much more than during the Asian financial crisis of 97-98. Korea is interconnected and interwoven into the global economy and the global financial system. But in our view, Korea does not face exceptional pressures and is not in a particularly vulnerable position. Indeed, if you look around Asia, yes, you see a slowing of the Asian economies. There is somewhat slower growth here in Korea. In China, growth is moderating from 12% last year to 9% next year. In India, growth is moderating from 10% last year to 7% next year. Now, these are significant changes. And as you know, the fallout from the global financial stress, when combined with the very adverse shock of the run-up early this year and last year of global commodity prices, especially global energy prices, these two seismic shocks have hit the global economy hard. But still, during this period, the U.S. economy has managed to still move forward, which is remarkable. Many forecast that we would fall into recession in the first half of the year. We did not. Now, I'm afraid that the chances of a recession have grown in the last week or two with a new bout of financial turbulence. But still, we do not see a global recession at the Institute. We see relatively weak growth for a 2 to 3 year period in the U.S. and Europe and Japan, and therefore relatively weak growth in emerging markets. But even in spite of the weakness that has been evident in the U.S. economy for some time now, and the growing signs of weakness in Europe and Japan. We just came from Japan, where, as you know, they had a very negative second quarter of performance. But it's not all bad news there, and it's not all bad news globally. And even in spite of that, I think the latest figures which Greg gave me for Korean exports were something like 22% up in the first 8 months of this year. 22% growth in the value of Korean exports. $240 billion in foreign exchange reserves. Growth still, in spite of all of the global stress, running at an underlying trend of 4 to 5%, and a current account position which, with the recent correction in oil prices, is probably moving back more or less toward balance in their current account position. This does not seem to be to describe a country that's on the edge of a crisis. And so one of my messages this morning would be for our leaders in Korea to continue to focus on improving the underlying fundamental structural strength of the Korean economy, not to be so worried about the volatility of the markets, not to be so concerned about what's happening with the Korean won or what's happening with your interest rates or what's happening with your stock market. Of course, it's easy for me to say because I'm not responsible for the Korean economy. But I do believe that it's important to keep focused here in Korea on medium and long-term goals for the Korean economy and for the Korean companies and for Korean financial institutions, and not be distracted by short-term market volatility. You know, some years ago when I was at the Treasury Department, and those of you who have worked in government understand this very well, you know, if you've been working in a government agency for a while, especially the finance ministry, you begin to learn something about your own field. And in the 1980s, I learned a lot about exchange rates. Indeed, I spent some time here in Korea talking about exchange rates, as some of you will recall. Yes, I see my old friend, Mr. Hu, here, who helped work with me at the Ministry of Finance in those days, along with Dr. Il Sagong and many others, in finding solutions to some of the global imbalances of the 1980s and the early 1990s. But one of my jobs in 1988 was to try to take a brand new Treasury Secretary, whose name was Nicholas Brady, and help him cope with a very volatile exchange market. The dollar was very weak at the tail end of the Reagan administration. You know, we had gone through this plaza period when we had tried to drive the dollar down, and then we had gone through a period where we had tried to stabilize the dollar. Now we were in another period of dollar instability. And he was going on Meet the Press. Well, you've all seen Meet the Press. And he was very inexperienced in exchange rates. He was very experienced in finance and global equity markets. And so we told him, whatever you say, don't say anything that will undermine further confidence in the dollar or put more pressure on the dollar, because we're already in trouble. And I was hearing from the Federal Reserve, who said, you know, every time the dollar weakens, we have higher inflation, and that makes it more difficult for us, and we have to tighten monetary policy, and that weakens the economy. So please don't let the dollar slip further. And we were marginally involved in intervening in the exchange markets, but not too heavily. So he got on the press that morning, and they said, what do you think about the dollar, Mr. Secretary? I think he'd been in the job for 3 days. And I'm at home watching him on the TV, and I grimaced because his answer was, oh, he said, I don't worry too much. Markets go up and down, you know. And this expression, markets go up and down, of course, was seen by the markets as a tolerance for further dollar depreciation. So the next morning when the markets opened, they just pounded the dollar. And we lost another 2% in value. And I went into him and I said, Mr. Secretary, why did you say this? Why did you say markets go up and down? He said, well, I know it probably wasn't the smartest thing to say, but it's the truth. And we have to learn to live with some volatility in foreign exchange markets, just as we do in equity markets and just as we do in the bond markets. Well, I wasn't very happy with his performance, but I must say there was some validity in his answer. And as I look at Korea today, I also feel that there needs to be some understanding here that markets go up and down, and that the fundamental strength of the Korean economy remains quite strong. I look at your banks today, many of whom are increasingly involved in the activities of the Institute. And I see banks which are well positioned to take advantage of some of this global volatility and spread their wings cautiously, both through consolidation here in Korea, but also spreading their wings in the Asian Pacific region and even globally. The Korean banks and the Korean securities firms and the Korean insurance firms are well positioned to move forward cautiously but steadily and globally. And they will need to think globally and to strategize globally if they are to succeed in the years ahead, just as the Korean industry has done quite successfully for many years. Here you are today with your exports to China much higher than your exports to the U.S., which leaves you much less vulnerable directly to the weak growth in the U.S. than it would have even 10 or 15 years ago. Now, I realize that the government here will want to take some measures to support the economy. And frankly, and this may not surprise you since I served for many years in the Reagan administration, but frankly, I'm pleased to see the tax cut proposals which the government has on the table, because I think they can inject into the Korean economy some new competitiveness, some new dynamism. I'm also pleased at the new push for deregulation in the Korean economy, because to me the Korean economy still remains somewhat overly rigid. And the deregulation, in my view, needs to extend not only to the industrial sector, but into labor markets and into the services sector. Because if you look at the growth of Korea in the last 7-8 years, it has not generated many new jobs. And I know that concerns all of you in this room. If the growth of Korea in the next decade is to be different, it will have to be job creation through the technology and service sectors. Because your companies, just like American companies and just like Japanese and European companies, are increasingly find that it is competitively at their advantage to take their production elsewhere. But if you can globalize the service sector in Korea, you will not be facing 10 years from now what you are facing today, which is growing numbers of college graduates unable to find positions and a real concern about the capacity of the Korean economy to generate new jobs. But this will take further change, in my view, and it will take leadership. You know, for many years, the Korean leaders have been discussing the development of Seoul as a financial regional hub. My old friend, Dr. Ambassador Kim Ki-wan, has steadfastly pursued this. No matter whether people were listening or not, he has steadfastly pursued this. And now this is gathering renewed momentum, and in my view, rightfully so. And I would strongly encourage the leadership here in Korea, because you have such capable leadership now with President Lee and his team, to move from rhetoric to action and to develop the concrete plans which are needed to build on the earlier progress. Because to be honest and to be fair to previous governments, progress has already been made in deregulating the Korean financial sector. And you see this in the increased legal capacity of firms to integrate their banking, securities, and insurance operations. You see it in the growing openness of Korea's financial system to foreign entrants, to foreign participants. But this is not just about financial rules, and it's not just about financial IT, and it's not just about having a physical financial center, although that's an exciting idea that I've heard here in the last few days. But it is about changing some of the broader attitudes and characteristics of your approach toward making this a really friendly place for foreign financial experts to come and want to work and want to live and want to raise their families. There are educational issues, there are language issues, there are a host of issues which are not easy to deal with, because these are not matters just for the Financial Services Commission or for the Minister of Strategy and Finance. These are matters which cut through the Korean government and cut through the Korean society. But I do believe that Korea has considerable potential to strengthen its role as a regional financial platform, and for its financial institutions to become not just strong players in Korea, but strong players in the region and globally. Of course, there are other areas of deregulation and structural reform which remain to be tackled here. I'm very pleased that Dr. Il Sung is leading this commission on competitiveness, which I gather is very much focused on further deregulating the Korean economy. I'm pleased to see the new push for privatization that has a high priority in the government. You know, sadly at this point we seem to be nationalizing institutions in the United States for the moment out of necessity. Well, you're in the right spot here because you are privatizing them after you had to go through a period of injecting government capital into the institutions of this country some years ago. As I look at the global landscape, it is as uncertain today as it has been in modern economic and financial history. But as I look at it here from Seoul, I see not only a challenging world environment, but a world environment of opportunity. I see a country which has accomplished so much in the last decades, and in spite of some weaknesses which still persist here, a country which should be well positioned to survive the current storms and to come out of it in an even stronger position than you are today. Thank you for having me with you here this morning, and I'll be glad to take some of your questions.
Hopes and hopes for the future to the audience. Do you agree with me? I know that we know that the history teaches us that only the positive thinkers can accomplish great things. I think Dr. Dallara's the major thrust of his presentation is that although the current financial situation is very challenging, very difficult, very complex, and there are many reasons for us to worry about the prospect of the global financial community. And he even admits that it will take some time, such as 9 or 12 months, to recover the stability of the global financial market. But I think the main thrust of his presentation is that we should not lose our sight because of this short-term volatility, short-term fluctuation. He explained that financial community have been preparing the self-help measures to improve the fundamental workings of the financial industry. And the financial market is now undergoing the adjustment process, including the consolidation process, which is necessary for retaining, recovering the stability. And in particularly encouraging is that the several recommendations he has made to the Korean audiences for the Korean economy. It is very encouraging for us that the current situation is providing the new opportunities for Korea's financial industries. And by focusing on reforming our fundamentals, then Korea can take many opportunities from the current, the very unstable or volatile the international financial market. I think this is a very positive and a very encouraging recommendation to the Korean people, because recently we all are witnessing that we are too much trapped in the day-to-day the volatilities, day-to-day fluctuations of the global economy and of the Korean economy. And I just wonder that we are losing sight of the taking whole picture of the Korean economy. This is my understanding of his presentation. Of course, although he has made the excellent presentation, but still you have some questions in your mind. So first, there is one the written question. So let me entertain this question first. This is a question from the Mr. Woo Young-hoon at the Lotte Economic Research Institute. The question is, let me read. I agree to your opinion that the weak supervisory system worked as a key element of the current financial turmoil in USA. In particular, most supervisory agencies seem to neglect risk that financial derivative may cause. In order to prevent similar turmoil from taking place again in the future, I think it's necessary to strengthen regulation on financial derivatives. I'd like to ask your opinion on this.
Well, I think that there have been regulatory oversights, and I think that they need to be addressed. But strengthening regulation of derivatives is not an easy thing. Firms will need to do a better job in managing their derivative risk and in stress testing their portfolios. And regulators will need to do a better job at monitoring that risk management and in discussing with the firms the stress testing. Part of this is just old common sense and good sound risk management. Don't build up so much leverage and don't put risk on your books that you don't fully understand. This should not require a great deal of micro-regulation. In fact, I see that Korea continues to move down the path of a principles-based regulatory structure, which I believe is the right direction. But it does require a good bit of discipline, and it requires more coherent regulatory structures. Today, we in the United States, and to a lesser extent in Europe, should be absolutely embarrassed by the incoherent regulatory structures we have. And I would hope that coming out of this crisis will not only be more effective regulatory structures, but more coherent, more globally consistent regulatory structures. You know, one of the real problems we have today is that financial institutions are increasingly global, but they operate around the world, and almost every jurisdiction has a different set of regulatory rules and requirements. This makes no sense. And indeed, when I was last here in Korea, some 16 months ago, the former chairman of your Financial Services Commission, Chairman Yoon, hosted a gathering of all of the regional regulators from all over Asia Pacific with bankers to talk about how to reduce unnecessary inefficiencies and inconsistencies in regulatory environments. So while we as bankers do not speak too loudly today about shortcomings by regulators, because we are in no position to point fingers at anyone else given the magnitude of the mistakes made by the banking community. And if there were ever a time for humility by bankers, now is the time. Nevertheless, regulators have to recognize that they have created a remarkably incoherent, inefficient world of global regulatory structures which really need to be improved if we're going to find a more stable global financial system.
My name is T.S. Chung. I head up Invest Korea. We have a saying in Korea, you know, the world changes in 10 years. It certainly has changed a lot. 10 years ago, Korea was in financial crisis. And now, what we look up to as the big brother, the U.S., is in financial crisis. To get out of the financial crisis, Korea had to take very difficult measures, many of which were really dictated by the IMF. A lot of Koreans felt that that was dictated actually by the U.S. through the IMF. Whether that is correct or not, Now, U.S. has to take some very difficult measures to get out of this current financial crisis. But without someone like IMF forcing, there's some doubt that the U.S. will be able to take politically and otherwise difficult measures that they know have to be taken, but very difficult to execute. How do you feel the U.S. is really going to handle this? Because, U.S., we've looked up to the U.S. as the global standard, and that global standard is failing right now. We're also in the midst of a presidential election in the U.S., and do you feel that the approach taken by the new president will be any different in addressing this issue if a Democrat is elected versus a Republican? Thank you.
I'd like to raise one question. Last 20 years, we have seen the investment bankers are growing, but suddenly through this financial crisis, investment bankers are going down. So Bear Stearns are taken over by JP Morgan Chase, and Merrill Lynch is going down, taken over by BOA, and which one? Yeah, Lehman Brothers are going down. So, do you see this change, these movements as starting of the industries? Commercial bankers are coming again, and investment bankers are going down. How do you see this movement?
Since World War II, I think the U.S. financial market worked as the central global financial center. So, do you think the current financial turmoil in the United States may affect the role of the U.S. financial market? So, what kind of impact do you expect on the future role of United States financial market in the global financial market? Thank you.
But just a few things. Yes, of course, I think going back to the question, it's only natural sitting here in Korea to think back to your experience 10 years ago, 11 years ago, and to ask, will the U.S. have the discipline to deal with its problems? We in Korea worked closely with the IMF for better or worse. And I do think, in hindsight, that the IMF was a constructive partner, actually, in helping Korea work through some of the difficult reform measures that you had. And in some ways, I would like to think we could be in a world where the IMF could be a constructive partner of the United States. But it's not practical today, certainly not on a bilateral basis. In some real sense, the markets have to provide the discipline that the IMF or other external agency has provided in other crises, in other economies. The IMF, in my view, could play a role, but not just focusing on the U.S. There is a great need, in my view, for a reinvigorated IMF, which could pull together a cooperative set of policies among all of the major economies to see if we can move through this period of enormous turbulence and actually survive with growth being sustained and with inflation being contained. And this is a global challenge. It's not just a U.S. challenge, and it's not just focused on the financial markets. It has to do with trade policies, it has to do with structural policies, it has to do with agricultural policies. And in my view, the IMF should take some leading role. Whether they will do so, I do not know. They are struggling because, as you know, they're still very heavily influenced by the G7, and the G7 is out of date. The G7 should have moved on to a G11 or a G12 some years ago to invite countries like China and Brazil and Korea into these discussions, but they have not. And so I think this handicaps the work of the IMF in today's global economic environment. I do believe that this will demand the resolution of the problems in the U.S. and Europe today, will demand strong leadership, political leadership and financial leadership. And to be honest, I think both candidates are untested in this arena of financial stress. I saw them on the news the last few days trying to find something to say, and it was not easy. And without revealing my own preferences at all, I think that both of them are going to have to be prepared from day one. And they will have to show leadership in reforming the regulatory structures. And this has to be an immediate high priority. And also perhaps in taking stronger action to stabilize the housing market. We may have to take action even during this interim period. You know, I remember in Korea, you were forced to take some difficult decisions even while you were moving from one government to another back in 1997, 98. We may be forced to do the same. It may be an extraordinarily challenging interregnum and transition period between November 4th and late January. So we have to be prepared, I think, to step up. In the long run, I do believe that U.S. capital markets will come out of this even stronger. And so I'm not very concerned about the long-term position of U.S. capital markets here. I believe that the depth and liquidity and the vibrancy of our capital markets will continue to be a major attraction for global investors around the world. But I do believe we have to address the risk management weaknesses of the financial institutions and the regulatory weaknesses if we are to sustain our position. Finally, on the question of investment banks. I don't think it's quite so black and white that investment banks are going down and commercial banks are coming up. The model of independent investment banks, largely dependent upon wholesale funding and with high leverage, that model is over. That model is over. Independent investment banks, strictly dependent upon wholesale funding in the financial markets with no deposit base and high leverage in their balance sheets. I think that model is over. But investment banking activities as part of diversified financial institutions remains a very vibrant source of revenue and a very vibrant part of our financial system. And I think we have to realize that many investment banking operations of many large global firms have managed their business relatively well in the last year or so. So I think this is the model going forward. And clearly it's been a painful way to realize this. And clearly the regulators in the main financial centers will need to rethink their regulatory approach to both investment banks and insurance firms. Because if banking regulation is in need of serious improvement, insurance regulation is even in worse shape around the world. And this is something that we're getting involved in at the Institute as well.
You already said that the current financial difficulties in the Wall Street, particularly, provides good opportunity to Korea. Then the manufacturing industry has been moving from the west to the east, to Asia, in recent decades. Then, in similar the context, do you think the current development will provide another opportunity that Asia can take, the financial, the industries from the west to the east, the so-called power shift?
Well, I think it's a rather different proposition entirely. I think that there is scope to strengthen the role of financial institutions and financial markets here in Asia. As I have said about the concept of Seoul becoming a regional hub, including as a financial hub, I do not believe this is just dreaming. I believe it is something that you can strive toward and realize here. But Asia as a region has very significant challenges of language, cultural, geographic, political differences within the Asia-Pacific region that I think will make it difficult for Asia as a whole to grow into this space. I think it will be important for financial centers individually, like Singapore and Hong Kong and Tokyo and Seoul, to step up and seize the opportunities that they have rather than visualizing Asia as a whole to move into this space. But this will take a lot of change and a huge amount of reorientation, and I think that it's still going to take quite an effort to get there.
Now we can leave this room believing that there is very little or few reasons to become panic about the day-to-day, development in the global financial market. And we can believe that the global market will be reborn with much more stronger structure in the longer term. And the global economy might recover the growth in the medium or longer term, although the fluctuations and the volatility will continue for some time. I think that is a great message for all of us. And in that regard, we should appreciate Dr. Dallara. Thank you very much.
Thank you.